You're driving down the highway and you pull up next to a gleaming, chrome-covered luxury pickup truck. It's a heavy, wide-frame vehicle with a sticker price that rivals what some people pay for a house. The average new car payment in America has quietly climbed past $700 a month. For those driving a truck or a large SUV, monthly payments routinely range from $1,000 to $1,200. That creates an immediate math problem. The median household income in the United States has slowly crept up over the years, but nowhere near enough to support those monthly obligations based on traditional financial wisdom. The people driving these high-end vehicles usually aren't secret millionaires or trust fund kids. They are teachers and mechanics, nurses and office workers, pulling in regular paychecks. Making these numbers function in a household budget suggests a hidden process, a set of financial adjustments designed to make the math appear sustainable on paper. To see how this system operates, you have to look at the paperwork inside the dealership. A decade ago, the standard auto loan lasted 3 or 4 years. Today, that short-term loan is nearly extinct, replaced by a structure built entirely around manipulating the monthly payment. This chart shows how dealers execute that manipulation. The tall bar on the left represents a standard 4-year loan. Stretching that exact same principle over 8 or 10 years drops the monthly payment significantly. It gives the buyer a number they feel they can comfortably swallow. What the buyer often ignores in that moment is the cost of extending that timeline. They end up paying tens of thousands of dollars in extra interest over the life of the loan just to get that lower monthly number. Dealerships will sometimes try to mask this with offers of 0% financing, but the cost of that interest doesn't disappear. It is simply baked directly into the sticker price of the vehicle, meaning you pay full retail up front instead of paying a rate over time. Stretching the loan out creates a secondary condition known as negative equity. This graph shows the timeline of a new car purchase. The steep curve represents the vehicle rapidly losing value, while the flatter line above it represents the remaining loan balance. Because the loan is so long, the car's value plummets far faster than the buyer pays down the principal, leaving a gap where they owe more than the car is worth. When that buyer eventually gets tired of the car and wants to trade it in, the dealership offers a simple solution. They take that negative equity and roll it directly into a brand new, even larger loan for the next vehicle. The consumer is now trapped on a financial hamster wheel. They are constantly making monthly payments on an ever-growing pile of compounding debt, paying for cars they don't even own anymore. Getting the car off the dealership lot and into the driveway is really only the beginning of the financial burden. Modern trucks and SUVs carry massive ongoing operating costs. Comprehensive insurance premiums easily hit $200 to $500 a month. Commuting in a massive vehicle means fuel costs can reach $400 monthly. And because these vehicles rely on proprietary sensors and advanced electronics, a major engine repair bill can quickly exceed $10,000. To keep the vehicle running and the payments current, buyers have to restructure their lives. They skip family vacations, rent smaller apartments, and take on weekend rideshare jobs, effectively using their expensive truck to generate the income needed to pay for that exact same truck. When the cash runs out, the financial gymnastics become disastrous. People start swiping high-interest credit cards for basic brake jobs. They raid their 401k retirement accounts or take out home equity loans to cover down payments and negative equity. They are taking out loans against their own houses to fund a depreciating piece of metal, entirely reversing the purpose of both assets. Let's run the actual math on a single standard vehicle life cycle. Imagine taking out a typical $55,000 loan for a new truck on a 7-year term. This ledger tracks expenses over 7 years. $67,000 for principal and interest, $21,000 for insurance, $29,000 for fuel, and $15,000 for maintenance. The total reaches $130,000. But the harshest reality? When fully paid off, the truck is worth a mere $15,000. This 7-year cycle functions as a machine for wealth destruction. So why do otherwise perfectly rational people willingly defend a system that is destroying their personal finances? It comes down to what you could call automotive Stockholm Syndrome. The auto industry has spent billions marketing the idea that your vehicle is a direct reflection of your identity, work ethic, and social status. Because buyers are so focused on maintaining that status, they completely miss the opportunity cost. If a buyer took an $800 monthly car payment
and placed it into a simple index fund earning 8% annually, they would generate over $70,000 in actual compounding wealth over that same 7-year period. But once the vehicle is tied to a person's identity, suggesting they drive a cheaper used car is rarely received as sound financial advice. It feels like a direct personal attack on their success. The next time you are sitting in traffic surrounded by gleaming luxury trucks, remember the financial stress hidden right behind that chrome grille. A car is ultimately just a tool designed to get you from point A to B. The reliable used car in your driveway acts as a firewall against the modern debt trap.
You're driving down the highway, and you end up behind a brand new, oversized luxury truck. You know the one. Chrome everything, leather seats, and a monthly payment that would make your mortgage broker weep. Most of these drivers aren't secret millionaires. They are teachers, nurses, mechanics, and office workers. People with standard salaries, driving vehicles that cost more than the median household income. This creates a mathematical mystery. How are regular jobs funding $80,000 trucks? The average monthly payment for a new vehicle has pushed past $700. And if you're looking at trucks and SUVs, which dominate the road right now, buyers are routinely signing on the dotted line for $900 or even $1,200 a month. We are talking about rent-level payments for a vehicle. Look at this chart tracking the last decade. The blue line is median household income, drifting slowly upward. The red line is the average new car payment, accelerating aggressively away. Household earnings haven't matched this trajectory. The numbers are moving in two completely different directions. The math simply doesn't add up. Millions of everyday workers are finding ways to stretch their stagnant paychecks to buy an illusion of wealth, relying on an entire industry designed to make extreme financial gymnastics feel perfectly normal. This setup starts long before anyone signs a contract. The automotive industry spends billions on marketing to link a vehicle's horsepower and size directly to the driver's social status and personal success. Once that emotional hook is set, dealerships deploy their primary tactic to bypass rational budgeting. They stop talking about the total price of the vehicle completely and focus entirely on manipulating the monthly payment. Remember when a standard car loan lasted exactly 36 months? Those days are gone. To hide the true cost of these massive trucks, lenders stretch loan terms out to 6, 7, or even 8 years into the future. This bar chart breaks down the trap on a $60,000 truck. A standard 4-year loan forces a massive monthly payment that scares buyers. By extending the term to 8 years, the dealership drops the monthly hit to a manageable $900. Look at this top section of the 8-year column. That extension adds an extra $14,000 in interest alone compared to the shorter loan. Focusing strictly on that manageable monthly number guarantees the buyer hands over thousands of extra dollars. Worse, it keeps them making payments long after the truck has lost most of its value. So what happens when someone on an 8-year loan wants a different car by year 4? They haven't even paid off half the balance, and their vehicle has depreciated drastically. They owe more than the depreciated car is worth, a situation known as negative equity. Instead of writing a check to cover the difference, the dealership simply takes that remaining debt and stacks it directly onto the loan for the next vehicle. People end up continually paying off cars they no longer own. It is a financial hamster wheel where your loan balances keep growing with every trade-in, even though you make your payment every single month. Dealerships actively encourage this specific arrangement. By trapping a buyer in this negative equity cycle, the dealership eliminates the buyer's ability to shop anywhere else, creating a captive customer for life. To keep that base loan payment going, people make extreme lifestyle sacrifices. They'll eat instant ramen for lunch, skip family vacations, or spend their weekends driving for rideshare apps in their luxury truck, solely to generate the income needed to pay for the truck itself. The problem is that monthly loan payment is only a fraction of what it actually takes to keep a modern machine on the road. This brings us to the total cost of ownership. This diagram illustrates the true drain on a budget. We start with a base $800 loan. Then you factor in the reality of insurance. Full comprehensive and gap coverage on a heavily financed vehicle easily adds $250 to the pile. Next, these massive vehicles often get about 15 miles to the gallon. Even a basic daily commute drains another $350 every month for fuel. Finally, modern trucks are complex. When an advanced transmission fails, it's a $5,000 bill. With no emergency fund left, this breakdown forces cash-strapped owners to dump maintenance costs onto high-interest credit cards. Ignoring the total cost of ownership turns a vehicle from a simple mode of transportation into a financial parasite. It easily consumes up to 30% of a household's take-home pay. Let's run the final forensic math on a $55,000 truck with a 7-year loan. We combine the original price, the financing interest, the insurance premiums, the gas station visits, and the inevitable repairs. Over those 7 years, the buyer spends over $130,000, and at the end of that term, they are left holding a heavily depreciated asset worth only about $15,000. The real tragedy is the opportunity cost. Look at this split-screen comparison. On the left is the reality of the truck purchase. On the right, we take that exact same $800 monthly payment and put it into a simple index fund earning 8%. Instead of a rapidly decaying piece of metal, you build over $70,000 in real wealth. Extreme vehicle financing is a highly efficient system for transferring cash out of the middle class. It is active, systemic wealth destruction, equipped with cup holders. So why do people defend this trap? Once someone signs the paperwork, they often develop automotive Stockholm syndrome. They become fiercely protective of the very financial decision that is actively ruining them. The auto industry has spent billions ensuring that personal identity and social status are inextricably linked to what's parked in your driveway. Suggesting someone trade down to a reliable used car doesn't sound like practical budget advice. It feels like a personal attack on their life's success. This kind of emotional manipulation is incredibly potent. It drives people to make terrifying compromises, like pulling from retirement accounts or borrowing against their own home equity, just to protect their status symbol. Escaping this cycle requires breaking the psychological link between who you are and how you get around. A reliable used car offers something far more durable than status. It provides the capital needed to actually secure a financial future.